Revaluing U.S. gold reserves from $42 to $2,800, the economic ripple effect on the dollar, stocks, and bonds. This analysis explores the potential economic consequences of revaluing U.S. gold reserves from $42 to $2,800 per ounce, examining how such a shift could devalue the dollar, lead to higher prices for essential commodities, and trigger significant changes in stock and bond markets. Introduction. Gold has long been a cornerstone of global financial systems, serving as a store of value and a hedge against inflation. Historically, the U.S. dollar was directly tied to gold, with the United States holding vast gold reserves that backed its currency. When the U.S. officially abandoned the gold standard in 1971, the price of gold was fixed at $42 per ounce. However, the market price of gold has risen significantly since then, now standing at around $2,800 per ounce. The revaluation of U.S. gold reserves from their historic price of $42 to their current market value of $2,800 per ounce could have profound consequences for the U.S. economy. This analysis will explore the economic ripple effects of such a revaluation, focusing on the potential impact on the dollar, commodities, stocks, and bonds. The impact of gold revaluation on the dollar. A shift in the price of gold has far-reaching implications for the currency that once directly correlated with it, the U.S. dollar. If the U.S. were to revalue its gold reserves to the current market price, the nominal value of the dollar would decrease significantly. Gold has historically acted as a hedge against inflation and a measure of the dollar's purchasing power. If gold is repriced upwards, the dollar's purchasing power relative to gold would be reduced. As a result, U.S. consumers would experience a noticeable loss in purchasing power, particularly in sectors that are sensitive to inflation, such as food, energy, and housing. Essential goods and services would likely see their prices rise as the value of the dollar diminishes relative to the new gold price. 3. Repricing of commodities and hard assets. Commodities, such as oil, food, and energy, have long been priced in U.S. dollars. However, the actual purchasing power of the dollar relative to these commodities can fluctuate based on broader economic conditions. Historically, gold has been seen as a benchmark for valuing these assets. When gold is revalued upwards, other commodities, which may be pegged indirectly to gold, are likely to follow suit. For instance, oil prices, while denominated in dollars, are influenced by the global perception of dollar strength. If the dollar loses value due to the gold revaluation, oil prices would likely rise in U.S. dollar terms as producers and investors seek to maintain the real value of their assets. Similarly, real estate, which is considered a hard asset, could see prices climb as investors shift capital into tangible assets that are more likely to hold value in an inflationary environment. Housing prices, along with other essential goods, would become more expensive as their relative value rises with the dollar's depreciation. The stock market, a hard asset hedge. Stocks are often considered a hard asset and a hedge against inflation because they represent ownership in companies that can adjust their prices in response to inflationary pressures. As such, the stock market would likely see an upward repricing in response to the revaluation of gold. When the value of the dollar falls due to gold revaluation, the real value of stocks, which represent ownership in tangible assets, becomes more attractive. Investors typically seek stocks as a safe haven from inflation, as companies with tangible assets, like real estate or natural resources, are better able to maintain their value in inflationary periods. Consequently, the stock market could experience a surge in demand, pushing stock prices higher. The increase in demand for equities would also stem from investors' desire to hedge against the eroding value of the dollar. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. U.S. bonds, price drop and yield adjustment. The impact on U.S. bonds would be one of the most dramatic consequences of a gold revaluation. Bonds operate on an inverse relationship between price and yield. When bond prices fall, their yields rise, and vice versa. The revaluation of gold, signaling a loss in the purchasing power of the dollar, would likely trigger inflationary pressures. In response, bond yields would need to rise to compensate investors for the increased inflation risk, which would drive bond prices down significantly. Existing bonds, which offer fixed coupon payments, would become less attractive relative to newly issued bonds that offer higher yields. This is because the fixed coupon payments would not keep pace with inflation, eroding their real value. As a result, the price of current bonds would likely fall precipitously, as investors would demand higher yields to offset the opportunity cost of holding bonds that no longer offer adequate returns in an inflationary environment. Second-order economic implications. Beyond the immediate effects on the dollar, stocks, and bonds, the revaluation of gold would have broader economic consequences. The increased inflation resulting from the dollar's devaluation could lead to a wealth redistribution, with those holding hard assets, such as real estate or stocks, benefiting from the increased value of their holdings, while those holding cash or fixed income assets like bonds would lose purchasing power. In the global context, the revaluation of gold could also accelerate de-dollarization. As the U.S. dollar weakens, countries that rely on exporting to the U.S. may seek alternatives, reducing their dependence on the dollar and increasing the appeal of other currencies or commodities, like gold, as storehouses of value. The potential for higher inflation and rising commodity prices could also prompt global shifts in trade relationships, with countries adjusting their strategies to mitigate the impact of a weakening dollar. Conclusion. The revaluation of U.S. gold reserves from $4,200 to $2,800 per ounce would have profound and far-reaching implications for the U.S. economy. The most immediate effect would be a significant devaluation of the dollar, leading to higher prices for essential goods and services. At the same time, stocks, seen as a hard asset, could be repriced upward as investors seek inflation protection. Bonds, however, would face a sharp decline in value as the fixed coupon payments would no longer compensate for inflation. This shift would not only disrupt domestic markets, but could also contribute to a broader economic realignment, with potential consequences for global trade and the role of the U.S. dollar in the international system. As such, the implications of revaluing gold reserves go far beyond the realm of gold itself, affecting the entire fabric of the global economy.